Hey guys, welcome back. Now, as you probably know, Aussies love a good property debate. One camp swears property is the only way to grow wealth. The other insists ETFs, shares, are far superior. But here's the truth. Pitting property against ETFs is the wrong question. The real strategy, knowing how to combine them into a balanced portfolio that compounds your wealth safely and efficiently, that's what we should be discussing. And today, I'll show you exactly how. And stick with me, because later in the video, I'll show you how a real-world example of an Aussie investor who split their strategy 50-50 between property and ETFs, and how in just 15 years, that combination left him with nearly $1 million further ahead than if they went with only one option. Now, property or ETFs, which one builds more wealth? If you're like most Aussies, you've probably heard heated arguments on both sides. Property people say, real estate always goes up, leverage is king, and shares are unstable. ETFs and shares, they say, well, we're diversified, cheaper to manage, and outperform property in the long term. But here's the big insight. Wealth is not about which camp you're in. It's about how you design a balanced portfolio that harnesses both. That's the strategy elite investors use. And today, I'm going to break down exactly how you can do the same. Right now in Australia, property prices are surging again after interest rates have dropped. ETFs have exploded in popularity. In fact, over 2 million Aussies now invest in ETFs. The question is, where should your money go first? And more importantly, how do you allocate between property and ETFs so you're not overexposed to just one market stock or one asset class? Now, here's the thing. If your entire wealth is locked up in a single city suburb or a single ETF, you're playing a risky game. A balanced approach can give you both stability and growth. Now, step one, the strengths of property. Let's start with the obvious here. Leverage. With just a 10% or 20% deposit, banks let you control a $600K property. That's instant leverage. If the property grows by just 5% a year, that's 30 grand gain on a much smaller cash outlay. Tangibility. Aussies love bricks and mortar. You can see it, touch it, add value through renos. Stability. Property values, they don't fluctuate daily like shares. They're less volatile and they give a lot of people peace of mind. You've also got tax benefits. Negative gearing, depreciation, and eventually capital gains concessions mean property can be very tax efficient. But, and there's always a but, property comes with some big upfront costs. There's stamp duty, transaction fees, ongoing maintenance, and the inability to sell off just half a property or a room if you just need quick cash. So let's look at ETFs. Diversification. In a single ETF like VAS or VGS, you own hundreds of companies across multiple industries. There's liquidity. You can buy or sell quickly and even invest just $500 at a time. Much more flexible. It's also cost efficient. Management fees are tiny compared to real estate agent fees or stamp duty. Dividends. Many ETFs pay dividends that can supplement income or be reinvested to compound faster. The downside? Volatility. The ASX 200 can drop 20% in a bad year, and unlike property, you see that red number every single trading day. It takes emotional discipline to stick it out. Now, let's put them both head to head. All right, so if we look at them side by side in numbers, so you can see the reality. Imagine you invest 100K into a property as a deposit for a $500,000 home in, say, Brizzy. Over 10 years at an average of 6% growth, that property becomes about $895 in value. Your equity gain, roughly $395K minus costs. Now instead, let's put that same 100K into an ETF and an 8% annual return, which is compounded. After 10 years, it grows to about $216,000. Less dramatic, right? But it was liquid, diversified, and far more simple. So property wins on leverage. ETF wins on accessibility and flexibility. But together, they become a powerhouse. So what is a balanced portfolio strategy? Well, this is where the magic happens. Instead of stressing over which is better, combine them. Property builds your base wealth through leverage and long-term growth. ETFs, they add diversification, liquidity, ongoing compounding power. Think about it like this. Property equals your engine room for capital growth. ETFs, shock absorbers, and accelerators for income and flexibility. So a balanced strategy for Aussies might look like this. Buy your first property, then start dollar cost averaging into ETFs while holding that property. Then when you purchase your next property, continue building your ETF portfolio in the background. Over time, you end up with property equity growing wealth in chunks and ETFs growing wealth consistently week by week, month by month. So the story I was talking about earlier, Mark and Emily from Newcastle, I think they were 35 and 33 at the time. Household income was about 180K. They bought their first investment property for 600,000 with a 120K deposit. At the same time, they committed $1,000 each month into ETFs via an online broker. Fast forward 15 years, the property grew to about 1.4 mil. After mortgage payments, they had roughly 800K equity. Their ETF contributions plus compounding grew to about 420K. Now combined, they had over 1.2 million assets beyond their mortgage balance. If they had just gone with property, they'd likely have about 800K in equity, and that's about it. Still a good number. If they had just gone with ETFs, they would have ended up with about 420K. But by combining, they ended up with nearly $1 million ahead and a much safer, flexible portfolio. Now, let's be clear. This isn't perfect or risk-free. Property can stagnate, especially if you buy in the wrong suburb at the wrong time. ETFs, they can crash 20 to 30% in the short term, and you need discipline to manage both without overstretching yourselves. But Aussies who can think long-term, build steady cash flow, and stay the course, property and ETFs together have historically created the strongest outcomes. If this is clicking for you, and you're starting to see that it's not just about property versus shares, but how you combine the two, do me a favor, hit the like button and subscribe so you don't miss more in-depth breakdowns like this each week. Now, if you're watching this and thinking, that sounds great, but how much should I put into property and how much do I put into ETFs for my own situation? Well, that's exactly what we help people do. We map out your situation in a free strategy session. We look at your income, your borrowing power, your risk tolerance, your appetite, and build a personalized roadmap. So if you want clarity on your property and ETF mix, click the link below, book your free session, and let's work out together. In the next video, I'm going to break down trust and ownership structures, how to actually hold your investments so you're protecting your wealth, minimizing tax, and setting things up for the long term. This is where many Aussies miss huge opportunities or get themselves stuck. So make sure you subscribe because you don't want to miss that one.